we all know, NBFCs have been doing well. You just have to look at the last quarterly numbers. The pace of growth for NBFCs has been twice of that of banks. Customer bases have largely normalized across NBFCs. Asset quality seems to be under control, and there seems to be very, very few red flags. But what we intend to do is to kind of look beyond a little bit from the here and now and look at and try and gaze into the future, medium to long term. So I'll sort of look at just 3 or 4 topics here, and then we'll kind of go back and forth with the guests. We'll look at the regulatory landscape. Is regulation sort of supportive enough? Is it hurting? Is it helping for NBFCs? The business model of NBFCs. We'll look at the credit cycle, where they are, where we are there. We'll look at the liability side of the business, which is cost of funding. And then I'll sort of wrap it up with the digital push and how that is playing up across NBFCs. So without further ado, let me welcome in our panel. Mr. Umesh Revankar is head of Shriram Finance. Mr. Revankar, thank you very much for joining us. Mr. Ramesh Iyer is Vice Chairman and Managing Director at Mahindra Finance. Sir, thank you very much. Rajiv Sabarwal is Head of Tata Capital. So thank you. Jairam Sridharan is Managing Director at Piramal Finance. Thank you very much. And Alok Agarwal is CEO, Muthoot Home Finance. Alok, thanks very much. The panel here, by the way, between them represents 5 lakh crores worth of assets under management, almost 5 lakh crores of assets under management. So, as I said, you'll get the entire sort of spectrum of NBFCs and business models. So let's, without sort of waiting any further, look at the first topic, which is the regulatory regime. One of the things which we used to talk about is the regulatory arbitrage between NBFCs and banks. Has that kind of gone away now for NBFCs? The Reserve Bank of India, the regulator, has tightened norms for NBFCs to be at par with banks, especially on NPA recognition, asset quality, etc. So I want to sort of take up that first. Mr. Iyer, I want to start by asking you, what is your view? Is that helping or is it starting to hurt a little bit?
So I think, all through the day you would have had panel where you would have heard what they cannot do. And NBFC exactly do what others say they cannot do. Right? And when we do that, obviously you will be regulated little more than what was required. But I think it's always been a misnomer, I guess, that when people say, oh, the arbitrage is kind of shrunk and whatever else. And we've been here in this industry for too long. And I'm not too sure that there were too many areas of gap that we were benefited by. NBFC by practice were flexible model. And the flexibility was both in choosing a customer and taking a formal credit approach and lending, and then cover it up through a better recovery process. That was a simple model that it was. Right? And if there was any, if at all, could have been probably on the liability side. But the truth is that when regulator just come out with a new requirement, I think it's futile that we start debating, is this right, is this wrong? It's better to look at how do you put it in your business model and revisit your model, and then it becomes an acceptable practice.
You began by saying, Mr. Iyer, what NBFCs were created for, which is to be able to do what banks could not do or were not willing to do.
Yeah, I mean, there was one question asked in the previous panel, right? That there are people who want 1,000 rupee loan or a 2,000 rupee loan or whatever else, and they were not probably able to get, and the rate of interest was very high or whatever. I think one should never look at it from one line item perspective. One should look at it collectively. If somebody's got a dire need of money and he's not getting it, you're meeting that requirement, then the cost of interest doesn't play a role there. The purpose plays the role, right? So I think that's the way the NBFC models have been built. So therefore, I feel that more regulation is always welcome. It only makes the business more stronger. I'll give you one very quick example. When we started the business, NPA was 365 days norm. Moved to 180-day norm, moved to 90-day norm. It's also moved now to daily collection. You have to date it. I think the businesses have survived and have become more stronger. So I don't think regulation hurts the business. It probably makes you ask more question about why and why now. So the timing of some regulations could probably be the discussion, but the need of the regulation probably is never the question.
Mr. Revankar, is this sort of bringing regulation at par with banks? Is it serving the need of what NBFCs sort of came into being in the first place, or is it a bit of a drag?
The way I look at it is, we became an NBFC by choice. We did not look at arbitrage to become NBFC. So, if at all we wanted to be bank, probably would have applied for a bank in the first instance itself. We chose a segment, we chose a product, we chose a service, we chose customers, and then we became what we are. And over the period we have grown. And as Ramesh said, the regulation, the RBI, as the NBFC have grown large, RBI is trying to harmonize and try to increase the level of the what you call regulation to NBFC, because NBFC have become large. And also NBFCs have started reaching to the customer who otherwise may be serviced by a bank. That's also a possibility. But we continue to remain servicing to those customers which typically NBFC can service. So I think the RBI increasing or not increasing, bringing or trying to harmonizing the regulation along with the bank and with pre-empting, in the sense RBI has been always informing it in advance, 1 or 2 or 3 years. So we are well prepared to move into that, and we are getting into it and managing it. So I don't think there is anything disadvantage to NBFC as of now. And all the NBFC have proved that they are able to manage the increased regulation quite well and perform well. So I don't really see disadvantage there.
Would I get the same answer if I spoke to smaller NBFCs? Because, I mean, all of you are... So let me actually just bring Alok in. Alok, of course, heads Muthoot Home Finance. Would you concur, or you think...
Yes, see, overall, as my co-panelist said, the regulator always works for strengthening the sector. But then there is also a target customer, and what was the objective of the company when it was established to service whom. Now, as you rightly said, the very focus and existence of NBFC was brought about to cater to a customer who would normally not get a lending from a bank. I, representing the affordable housing finance industry, we lend to a customer who's at the bottom of the pyramid, who would not be able to walk into an SBI of the world or an ICICI or an HDFC of the world, because he is almost, overloaded with the bank infrastructure itself, leave alone the documentary requirements. So we lend to a customer who just set up a roadside shop. And yes, today we are measured at par with the bank customers who's probably, Cat A plus salaried employee getting a bank credit of ₹1 lakh, his ability to repay and the uncertainties which my self-employed, unorganized customer having the willingness to repay but may not have the financial discipline to repay faces are totally different. So to that extent, customer segment is different, realities at the bottom are different. But yes, NBFCs have managed to endure that. We had been given time when the regulation of 180 days became 90 days. We were given a 3-year window to get this right. Now this 90-day window, the circular, we were given a 1 year, 1.5 year time. And now it is 0 day, it is daily stamping. And now we have to normalize the entire account before it is tagged off as non-NPA. Earlier there was an option of partial collection rollback. So that was working in favor of customers who couldn't maybe repay the entire thing but always had the intention to repay. Now even if they repay in part, they continue to be tagged as an NPA. And as and when they get continued to be tagged as NPA, the mechanism to process the recoveries continue on them. So it causes a little bit hardship in the system, no doubt, for the end customer also. But that's the way it is moving towards financial discipline. So, and companies have come up the curve, but yes, there is a little, discomfort when you go to the prime bottom pyramid of the customer at the customer level. To that extent, I would agree.
Okay, so I did get a slightly different answer, right? I mean, when I put that...
Prashant, if I may,
yeah,
I'll add one sort of analogy to this, which I think is somewhat relevant. So I have 2 kids, right? And growing up, I always thought I was being very lenient on the young one, right? And the younger one got away with stuff that the older one would never get away with. And so my older child was always resentful about this fact that, hey, this guy gets away with stuff, right? Now, my young one is a teen as well. On his 13th birthday, we gave him a phone. And along with that phone came a whole bunch of restrictions about his life. Now that guy, the little guy, now believes that life is super unfair, that all these restrictions should never exist. It is natural that when you grow older, bigger, and become a bigger part of the system, that restrictions will come in, right? For individual players, that might feel a little bit painful, but it's a natural evolution of the system, and without that, it'll be kind of chaotic in the market. So while it is true that yes, particularly for the larger NBFCs, the regulatory ecosystem looks more and more like banks, it is what it is, and you got to deal with it. It's good for the ecosystem.
You would all agree that we need more. I mean, I think an earlier panel was talking about how we need more banks. I mean, I think the SBI representative said that we need more financial institutions. So in that sense, and we need larger financial institutions if you are to be able to finance the needs of the economy, which will grow to 5 and then 10. It's a matter of time. So I mean, just come in there in terms of how the regulatory landscape is, and if it is all working towards that, and what needs to be changed, if anything at all.
If India is producing among the highest number of fintechs, if it's attracting the maximum amount of private capital, is it right to say that we are restrictive? I don't think so. It's fair to say that we are restrictive. I think it's fair to say that the regulator knows where innovation needs to be allowed, and when they sense that it is becoming large and we need to put controls, they are stepping in. I think that's the fair assessment, the way I would put it. See, we should all know that there are, spectrum of NBFCs and a spectrum of banks. If you look at the large NBFCs or HFCs, they are bigger than the top 5 banks, a lot of them. So, and you will find that probably the larger NBFCs are having much deeper penetration than a lot of other banks. So it's a spectrum which exists among NBFCs as well as among banks. So to say that banks are made for this segment and NBFCs for the other segment, I don't think so is right. See, we are a very large economy. Our lending book is now close to 1,40,000 or 1,50,000. Yeah, 1,50,000 crore, around that figure. And this is, on top of that, we have the NBFC lending space, which is about 20% plus of the total financial services lending book. So if our lending book is maybe about 180, 190 lakh crores overall, and we are saying that for supporting India's employment or income generation, the economy has to grow at least by 7 to 8%. It means that the credit will need to grow at over 15%. And if credit has to grow at over 15%, we know that out of 190 lakh crores, about 1/3 or 1/4 will get repaid every year. So that also needs to be lent. So just imagine about 15% of 2 lakh crores, that's about 30,000 crore, no, 30 lakh crores, 30 lakh crores, plus the repayment which is happening. You will have to substitute that also, which is another maybe 50, 60 lakh crores. So you will have to grow your book by close to 1 lakh crores. So do you have enough institutions which can support this growth? And that is why I think we need more institutions which can support this growth and allow for this credit to get delivered to the final leg.